real estate is not uh shielded by market, right? So it's like it's still exposed to market risk. And then there are sometimes, like for example, right now interest rates are still quite elevated, transaction volumes low. It's hard to exit properties right now, right? So we have
Mhm.
properties that we're done with, the business plan is done, but the exit is much harder, right? So we can't exit, and so we want to have the option to kind of hold it longer and stuff.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted
Hey
Patel.
everyone, this is Ted Patel. Welcome to this week's edition of Decoding Cashflow Podcast. I'm here with Zihao Wang, who is a co-founder and CEO of Motiva Holdings. Motiva Holdings is a California-based real estate private equity firm focused on developing value-added multifamily opportunities through syndications and joint venture partnerships. I'm sure you have, as we mentioned, right, before we started recording this podcast, you have ventured out of California currently in many other states. So maybe I'll let you talk about those details. So, Zhao, welcome to Decoding Cashflow. It's a pleasure having you on the show.
Thank you so much for having me, Ted.
All right. So, if you can give our listeners a little bit background about yourself, how did you get started in real estate and what's your main focus as of now?
Yeah, for sure. So I got started in real estate through the family. So my parents, first gen, moved to the United States in the early 2000s and then kind of continued their fashion business. And then set up the family office in the early 2000s and then started investing in real estate in 2008. And so kind of from there, I joined into the family office in 2016 on the property management side. Did that for
Mhm.
2 years, managing the family's assets before moving on to the acquisitions and capital markets side. And ever since then, I've been trying to grow the portfolio, building relationships with other family offices and joint venture partners, and growing the portfolio. We started very focused in Southern California. We're still quite focused in Southern California. Around two-thirds of our
Mhm.
portfolio is here. But throughout the years, we've also had some assets in Florida and North Carolina. And currently, we're trying to get something in Texas and trying to venture into our fourth state. And yeah, we're vertically integrated in Southern California. We have property management in-house, construction in-house. And even though we're a family office, we're very much active operators and try put in a lot of skin in the game into our own deals, but are also very, very hands-on.
Mhm. And main type of properties you said is a multifamily, right?
Yeah,
And
so
any,
we
yep, go
Yeah,
ahead.
so we mostly invest in multifamily, either existing properties or ground up stuff.
Mhm.
We've also done a student dormitory to multifamily conversion. We do have some other asset classes like triple net retail and mobile home parks, but primarily the portfolio is focused on multifamily.
Okay. And talking about Southern California, you mentioned two-thirds of your assets are in Southern California. How do you deal with all the rules and regulations, very, very strict, rules and regulations related to rentals? Everything is in favor of, the tenant, not the landlord. How do you navigate those situations over there?
Yeah, so we see it as like a trade-off, right? It's like we're very local to Southern California. We have our team in Southern California,
Hmm.
vertically integrated up and down. And so the trade-off really is like, do we want to operate in a place where we don't have local presence, but maybe a little bit more landlord-friendly laws, or operate in a place where we can drive to the assets, within 2 hours and be able to handle all of the nitty-gritty stuff ourselves and maybe deal with some of the I guess, tenant-friendly laws. And so kind of the decision from the beginning back in 2008 when my parents first started was to be local. We
Hmm.
felt that it was the best control. And so that's kind of why we started in Southern California. We wanted to be local, we wanted to be hands-on. And then, after getting our first assets, that eventually turned into more acquisitions and another 1031s. And that's kind of how we grew our footprint in Southern California.
Hmm.
Um, but like we're well aware of the tenant-friendly laws. So that's why we are currently thinking about, expanding and diversifying the portfolio to out of state, which is why Texas is a big kind of factor for us. And then that becomes a trade-off as well, right? It's like the supply
Yeah.
and demand is not as strong as it is in California. Much easier to build over there. Obviously, like tenant friendly and stuff. So there are like good and bads that we always consider in terms of trade-off. But
Mhm.
I would say the main reason why we choose to focus still in Southern California and have been focusing on Southern California is because of our local presence and our knowledge of the market, our relationships with local governance, with city council members, and just having this local presence and competitive edge that many other groups out there don't have.
Mhm. No, I totally agree with you. Regardless of the laws, different laws in different states, right? I'm from New Jersey, so New Jersey is similar to California. A lot of most of the laws are in favor of the tenants, but as long as the numbers make sense, you are well aware of the nitty-gritty of the law, how to navigate those situations. You well off regardless where you are.
Yeah, and I would also like just say that, our Southern California properties are typically on the smaller side, under 100 units. And for these smaller properties, it's actually better to stay in SoCal because you have a lot of 1031 capital wanting to deploy here. If you
Hmm.
have small of a property in like Texas, for example, where there's a lot of syndicators or a lot of institutional capital going in there, it'd be much harder to exit those smaller properties, which, it's counterintuitive because it's a smaller check, but for the institutional bigger players, they actually want bigger checks. So, for us playing in the under 100 unit space in Southern California, our current portfolio, for exits and stuff, we can find plenty of 1031 capital that provides that liquidity in the SoCal market.
Understood. So what are your main strategies to locate the right property, especially in the Southern California, right? Like how do you select the properties, like areas or based on the population? What strategies do you use?
So we typically look for more established areas. We like places like Anaheim, for example, which has, Disneyland and the commercial area surrounding Disneyland.
Mhm.
And one thing that's very important to us is to make sure that there's no local rent control.
Okay.
So, the entire state of California has the AB 1482 statewide rent control, but certain municipalities like City of LA, like City of Pasadena, City of Santa Monica, have their own local rent control ordinances that are even stricter than AB 1482. So we try
Mhm.
to avoid those areas as much as possible unless it's a vacant building. Those areas tend to be the most established with the highest rents. That's why they inputted the local rent control. So unless there's a vacant building, we really try to avoid those areas as much as possible. So
Mhm.
I guess location wise, we look for established areas that are still at the AB 1482 regulation level. And then in terms of the acquisition itself, we
Not at
look.
the local level, right? You said not at the local level, the rent
They're not
control.
at the local level, so at the
All right.
state level, the AB
At the state
14
level. Okay.
state level, right?
Mhm. Yep.
And then for the acquisition itself, we obviously we run our numbers, right? It depends
Mhm.
on what strategy we want to put into it, right? If it's a lighter lift or if it's a deeper value add, right? Whether we have
Mhm.
to relocate and re-tenant the entire building, right? Or whether we can just, increase rents year over year. I can give you two great examples actually. So a property we got in November of last year in Anaheim, walking distance to Disneyland. It was a 44 unit building that we added 12 ADUs onto it to get a 56 units. And then the rents were so low that we had to basically re-tenant the entire property, do our full rehab, lease up from vacant, there were tenants inside. We decided to re-tenant the entire property and go from 0% to 100% lease up again. And we were able to get over $1,000 per unit in rental upside per month, basically. So that's
Mhm.
one strategy that we employ. Another strategy that we employ is on a building in Downey, which we closed in July of this year, 90 units, $20 million. That one, the rental upside is between $300 to $500. So a little bit
Mhm.
less on the upside. And for that one, instead of re-tenanting the entire property, we decided it was much, much better to just kind of have a 5-year hold period plan and increase rents at the AB 1482 level, which is 5% plus CPI. Turned out to be around 8.9% this year. And so just doing that throughout the hold period can get us kind of the 19 to 20% IRR. And so we decided to kind of implement a much lighter value add strategy onto that property.
Mm-hmm. And the one thing that you mentioned, right, at the state level, the rent control 8% plus CPI, it's a yearly increase that you can do, or it's a
Yearly,
one-time increase that you can do when you find a new tenant. How does that work?
no, so it's a yearly increase on existing tenants is the
Okay.
5% plus
Oh,
CPI.
5%. Okay.
5% plus CPI is a yearly increase. If a tenant decides to move out, that turnover gets you straight to market rent without any limitation. That was
Mm-hmm.
something that was kind of like there are some cities where you think of like vacancy control, which didn't pass on the Prop 33 earlier this year. But
Mm-hmm.
basically, yeah, so at turnover, you can push rents to whatever you want. But if it was an existing tenant, then it would be 5% plus CPI.
And that's not bad. That's not bad. You can bring, maybe in a couple of years, you can always bring the rent to the market rent based on
Yeah,
that
so
calculations.
that
Yeah.
exactly. So that's why on the Downey property with only $300 to $500 upside, then you can
Yeah.
totally get that over a few years. But
Yeah.
on a property like the Anaheim one that we bought, where there was $1,000 upside, you'll pretty much never catch market rent in a growing market like Anaheim. So it's much more
Mm-hmm.
difficult if the upside is just that, that
Way
much
too high.
different.
Yeah.
Yeah.
Mm-hmm. And what are the specific strategies you use? Like maybe a thumb rules or, something to underwrite the property. If you see the property, what are the first, like maybe you can point like 5 thumb rules that you use to figure out, okay, do you want to uh, do a detailed underwriting on these properties or not?
Yeah, the very first thing I look for is the rental upside, right? So I
Mhm.
ask the broker or the lender for the rent roll, and I ask how much rents can I push, right? Where is market rent? Where is rent for this rent roll, right?
Mhm.
And if the upside's just not there, like some properties are already fully renovated, fully turnkey, there's no upside. It's more of a cash flow and long hold period kind of play. Then
Mhm.
that's not the right strategy for us, right? So we
Okay.
just pass on that property completely. And then so after seeing like the upside is there, I look at kind of what I try to learn a little bit more about the property, right? It's like whether it has deferred maintenance, right? How much money I need to spend per unit in CapEx, right? What's the occupancy, X, Y, and Z. So I learn a lot more about the property, right? And then I try to figure out is like where can I add value to this entire like opportunity, right? It's like
Mhm.
can I come in and add ADUs or can I come in and remodel the units and push rents, right? So that gets more into the detailed underwriting where we put it into our model and we look for, let's say a 5-year hold period. What do we do in year one? What do we do in year two? What do we do in year three? Can we exit at X cap rate in year five, et cetera? And then we try to negotiate the terms of the price, right? We obviously look at the going in cap rate, right? We look at can we hit like a low sevens return on cost, and then we try to hit our measures essentially,
Mhm.
and then eventually, we shop for debt and stuff like that. But like I would say, initially we try to get as much information as possible and try to see where we can add value, during our hold period and make profit from that.
Mhm. And talking about the cap rate, are you able to find good properties with a cap rate where you have a good spread between the interest rate and cap rate right now?
No, so typically you don't find like that good of a spread between
Mhm.
the interest rate and the cap rate, right? It's becoming more it's not becoming, it's always been kind of negatively levered going in.
Mhm.
So it's not, California is not the state to be in if you want to cash flow, like you want to have a property that generates a lot of cash flow, right? It's a property that you want to get appreciation from, right? So
Okay.
appreciation wise, like I don't, there are very few states that can really compete with California in terms of appreciation, right? But if you're more looking for cash flow, you should go into like a Texas, for example, Houston. has probably like a 200 basis point spread on the cap rate. That'll put you into positive leverage. For example, we bought the 60s deal in Downey, I was mentioning earlier, at around a 5.5 cap rate.
Hmm.
In Houston, if that was the same deal, kind of the 60s vintage, it would probably go for like probably like a 7, like high 6, 7 kind of cap rate, or maybe
Hmm.
even into the sevens, right? So you'll probably see a 150 to 200 basis point delta there. So yeah, on that side, we're much more focused on appreciation than the daily cash flow.
Hmm. So if you have a lower cash flow, right, then the amount that you get financed, the DSC ratio, that might be pretty high, right? Like maybe, and if you want to see on the LTV ratio, uh, just to make sure that you don't have to put money out of the pocket, right? You have to finance at maybe 65% LTV. Is
Yeah,
that the
we
case?
typically yeah, we typically do around 65%
Okay.
LTV off of like a 120 or 125 DSCR, depending
Hmm.
on which loan we can get. So it's probably like um, it's definitely on the lower leverage side. Like we wouldn't go up to like 80% leverage and stuff like that. Unless it's like a bridge, or even for bridge product, it's like somewhere around like the 65% LTC. So a little bit more proceeds in LTV, but typically 65% is what we're aiming for, like 120, 125 DSCR, something like that.
Okay. All right. So, and with regards to the asset management, you said you are vertically integrated in Southern California and do the asset management by yourself. Do you have a team of people who just takes care of the property? You have the asset management team?
Yeah, so on the corporate side,
Hmm.
I'm in charge more of the acquisitions and capital markets side.
Hmm.
But then I have a team of 12 people that are more on the operations side, right?
Hmm. Okay.
So yeah, I don't do everything, unfortunately.
Yeah.
But I don't have the time to do everything. But yeah, I do have a team that's built out here in Southern California. With that said, though, like out of state properties, I typically depend more on local operators and uh third-party property managers that can help do what we can't do over there.
Mhm. And any feedback that you like to give to our listeners on how to, decrease the operating cost, increase the income, decrease the expense, any as such strategies that you like to discuss?
Yeah, and I mean, I think the first thing first is to try to lower headcount, right? So I've seen properties where it's like a very small property, but they have like a full-time on-site manager who gets free rent plus paid a salary, and then also a full-time repairs, right? Who also
Mhm.
gets paid a salary, right? So when you have so much headcount on a property that's not that big, you don't really need to have full-time, you don't really need to have two full-time people,
Yeah.
and so from that, you can decrease a lot of costs just by trying to create a leaner team. On top of like creating a leaner team, I think it's also important to be really on top of your assets as well. Real estate, I always say kind of like problems can always be solved in real estate if you can discover those problems early enough, right? And so for us, we do weekly meetings with all of our property managers and alongside with the on-site managers, right? And so that ensures that we discover problems early enough so that it doesn't snowball into a bigger problem and really hurt us in the future. And so by discovering problems when they're still small and insignificant, fixing those problems at that point of time is a lot cheaper than if you wait for the snowball to occur and then you realize that you dig such a big hole, it's so expensive to fill.
Well, that's really, yeah, that's true. Uh, because there's a small leak in the apartment building, right? You got to fix it right away instead of just letting it go. Your water bill can go way up high, or that might affect the whole building, with
Yeah.
the water damage. So you never know. So that, like, we also have a few properties here in New Jersey, multifamily properties that we operate. Our main business is, ground up construction. We do serve uh, single luxury family spec homes and small multifamily we develop over here in New Jersey. And we also have long-term hold. We also do long-term hold of some of the multifamilies where it's positive cash flow. So say same like we have quarterly inspection for all the properties, detailed quarterly inspection, so that we can find out in advance if anything needs to be replaced before it goes bad.
Yeah, yeah.
Yeah, yeah, that's good. All right. And I see, in addition to your own family money, right? You also have external investors to invest along with your family office. Is that right?
Yeah, we have a few bigger high net worth individuals as well as
Hmm.
other family offices.
Okay.
Most of the capital does come from the family though. So
Okay.
we haven't syndicated that much, but we do bring on outside investors, yes.
Hmm. So what is the deal structure normally at Motiva for any new properties? How do you structure the deal?
Yeah, so Motiva Holdings and the family office are separate entities.
Hmm.
Motiva Holdings is the GP. We get a 20% promote for doing the work. We typically put in 10% of the equity in the deal. And
Okay.
then the family office, so I mean, my family office that, my parents control, they would come in as an LP. And then, depending on the deal, it depends on how much they want to come in, X, Y, and Z. And then I would try to get other family offices to come in as joint ventures on the deal as well. Um, and yeah, so that's typically how the capital stack is put together. In terms of distributions and profit sharing, we don't distribute any cash flow in the middle, because one, there's not that much cash flow given California's
Hmm.
cap rate.
Yeah.
And two is we try to use all of the cash flow, like all of the remaining NOI or net income after debt, to renovate the property. So
Okay.
we save up all of the net income to see if we can, maybe pull out less loan, stuff like that, and so we don't do any intermediary cash flow. It's a one check in the beginning when we acquire the asset, and then a one check out at the end when we sell the asset. So yeah, that's typically how the capital stack is put together and also how the profit sharing works.
Hmm. Okay. And normally your whole period is like 5 years, 6 years, or you do refinance and give money back to the investors. What's your main strategy, exit strategy, I
Yeah,
would say?
we've always modeled the kind of 3 to 5 years,
Hmm.
but we've exited properties within 8 months and 1031 into other properties. So we always, try to finish the business plan as fast as possible, do things as fast as possible so that we have options, right? When you finish operations, you really have options. And
Hmm.
then when we refi, we try to definitely cash out and give profits back, or I guess return of capital back to the investors. Um, but yeah, we've kind of exited properties within 8 months up to, our longest hold one was the first one in 2008. We still didn't sell that one. That one has been held for 16 years. So it's
Hmm.
it's really deal by deal basis on what the strategy is.
And any you have been doing this real estate transactions for maybe quite some time, right? So many years. I'm sure you might have come across some tough things or some challenges during your experience. So can you give us maybe a little bit, or maybe just one example on any of those challenges that you came through, and how did you mitigate it?
Yeah, sure. I mean, COVID was a big challenge in terms of
Yeah.
construction. Supply issues was very tough to manage, especially the electrical
Mhm.
panels. The switch
Yeah.
gears were very, very difficult.
Everything. The
Yeah,
price
yeah,
went up
everything.
the
Yeah, yeah,
roof,
yeah,
right?
everything went up. Yeah, yeah, yeah.
Yeah.
But so the market risk is there,
Yeah.
right? So real estate is not uh shielded by market, right? So it's like it's still exposed to market risk. And then there are sometimes, like for example, right now interest rates are still quite elevated, transaction volumes low. It's hard to exit properties right now, right? So we have
Mhm.
properties that we're done with, the business plan is done, but the exit is much harder, right? So we can't exit, and so we want to have the option to kind of hold it longer and stuff. Luckily, though, we did finish before schedule, and so it's good that we have the option to hold. But yeah, I would say risk wise, market risk is there. There's obviously operational risk, right? It's like there are like kind of uptrends and downtrends in the leasing part of the year. Like right now, holiday season, leasing is very tough. Summertime, leasing is much easier. So yeah, there's obviously operational risk, and then there's the market risk.
Mhm. No, absolutely. So the main thing is, as long as you have gone through the ups and downs, you're experienced enough, and uh, you can always mitigate the risk accordingly, right? When you have good experience and gone through the same cycles over and over again.
Yeah, I mean, like we have definitely tips and tricks
Yep.
on the operational side. For example, when it comes like kind of October-ish, we make the leases like 15 months instead of 12. So that
Okay.
ends in January during the kind of ends in January, February, kind of going into the springtime. It's much easier to lease. So yeah, there are small tips and tricks that
Tricks.
we
Yeah.
definitely implement based on our experience playing the market. And
Mhm.
then also kind of in terms of acquisitions, our comfort level in terms of how aggressive we want to be and how, where we see value, like, and how we can add value, stuff like that. We definitely see things that, people who are not in the industry don't see. And so that's kind
Mhm.
of our value add as operating partners and then also as somebody who's been in the industry for quite some time.
And during the acquisition of the property, like how do you source the deal, first of all? Like, is it through the regular markets, or you have some special campaigns going on to get these properties?
So it's typically either through brokers, like investment sales brokers, or
Hmm.
through lenders.
Okay.
So it's been it's been more like kind of on the lending side recently. But I haven't executed on anything like that so-called distressed yet because I don't think the distress are actually that cheap right now.
Mhm.
So it's a mix between brokers on the investment sales side. It could be on market or off market. And then another source would be the lenders.
So you approach the lenders directly to find out the distressed property.
Yeah, it would be lenders or like the like debt brokers, for example, also have a lot of information. Yeah,
Hmm.
but more on the capital markets side.
All right. That's good to know. All right. And with regards to the investors' relationship, right? Any specific strategies that you have implemented to, for the investors, to attract the investors, to make sure, they are well informed, and they just keeps repeating their the investment in your firm.
Yeah, it's try to be as transparent as possible. If they're a sophisticated investor, which is mostly kind of what I deal with, I try
Hmm.
to, I don't syndicate from like 50K, 100K checks. I try to, get a little bit more sophisticated investors. They
Hmm.
should be experienced enough to know that all asset classes have up markets and down markets. And so, obviously down markets is when you need to do more explaining than the up markets. So, during those downturns, you need to explain why certain things happened and why there's a path towards positivity. And then there is, how we're still on business plan or how the business plan needs to change X, Y, and Z. So staying transparent is very, very important, especially with sophisticated investors, because
Yeah.
they're understanding of market risk, right? And sometimes they can even get great suggestions. Sophisticated investors usually invest alongside many, many experienced people,
Yeah.
and strategies that worked for them in the past might work for them now again, right? So it's getting their opinions, right? Discussing what's going on in the market, right? Discussing how we should approach asset management or discussing how we should approach future acquisitions. All of that stuff, transparency and feedback is very, very important. Investors technically, they're business partners, but you should also treat them as friends and mentors. So that in that way you create a much closer relationship and closer bond. And then also just have a much better partnership, time working together as well.
Right. Yep. That's absolutely right. And the other thing is, if anyone wants to start into real estate, right? Start small multifamilies, not like 100 units or something, or maybe 10, 20, 15. What are your suggestions to him or her? How should they get, what are the steps that they should take to get into investing in multifamilies, small multifamilies, I would say?
Yeah, I would say watch first, like like join maybe like a mastermind or join a peer group or like go to events and conferences where you can see what other people are doing, right? So like one, you want to buy right first, right? So like you see what other people are looking for in these deals, you see what they're buying, why they're buying the things they're buying, so you can make a good judgment as to, the small property you have today, whether it's the right buy for you, right? So buy right first. And then during the operations side, number one, use a lot of common sense, right? It's like operations comes down to a lot of common sense. So be on the ball, be on the driver's seat, holding the wheel, and use a lot of common sense and try your best to operate the asset as efficiently and as lean as possible. So that's very important. And
Mhm.
then I think with those two things done right, if you buy right and then operate efficiently, I think real estate is a very safe asset class, right? I don't
Yeah,
think if you do those two things correctly, I don't think there's many things you can go wrong.
yeah,
And also I would say though, don't over lever and have liquidity, right? So like I think real estate sustains time. So, even if you do one of those two things wrong, or you buy wrong or operate inefficiently, make sure you have liquidity and don't over lever so that time will buy you that returns and that money back. So yeah, I think those are probably my tips to, starting investors.
yeah. All right. That sounds good. All right, Ziha, loving this conversation, but want to be mindful of your time also. All right, so would like to switch on to the final round of questions. But before we move on, is there anything else that you'd like to tell to our listeners?
Well, I would say make sure you do your due diligence before you get into a property or get together with a partner, whether that be an operating partner or a limited partner, just anybody. Do your due
Yeah,
diligence. Make sure you know what you're getting into. Most people kind of sort of understand what they're getting into, and then they
yeah,
just get in. That's the worst possible thing that can happen. Like even if you fail, you want to know exactly why you failed. So do your due diligence up front. Know exactly what you're getting into, and kind of in the middle, stay up to date, stay on the ball, and you'll be fine.
yeah. Yeah, yeah, educate yourself, right? Because the educated investor is the best investor, I would say.
Right.
Yeah, and you know exactly what your criterias are, what is your risk appetite, and then go along.
Yeah.
All right. Okay. Let's move on to the final round of questions. Are we ready?
Yeah, let's do it.
All right. Okay. So, which is the one book that had a most impact on your life or on your business?
I really liked Rich Dad Poor Dad by Robert Kiyosaki. The things he talk about is kind of at the elementary level, but it really shifts people's mindsets. Um, I think mindset and how you see your life and how you see business is the very first step you can take into becoming a great investor or great business person. So I feel that book really shaped my mindset, and I would recommend it to everybody who haven't read it yet.
Yeah, that's the Purple Bible. That's what we call, in the real estate industry.
Yeah.
Yeah. So, all right. So, what are your main source of information to learn or grow?
I love podcasts. Podcasts are good on to go, like on the go information. When I'm driving to one of my properties, maybe an hour away, I can put on a podcast, maybe listen to two, three episodes, and just get other people's opinions without having to pay for a conference or pay anybody, right? And so I love podcasts. I would recommend podcasts for everybody, and that's why I also like to do a lot of podcasts to share my experiences to other listeners.
That's great. And what is the best business or investment advice you'd like to give to our listeners?
I would say you gotta do your due diligence very, very carefully. I think if you know exactly what you want and what you're getting into, that's that's probably the best advice I can give. You have to know what you want and what you're getting into in order to have a chance at succeeding. So make sure you do your due diligence carefully. There are a lot of tips and tricks out there to do your due diligence. And yeah, be careful. Know who you're getting into bed with. Do your due diligence, and you'll be good.
All right. Okay, final one. How can Decoding Cash Flow listeners get in touch with you?
I'm active on LinkedIn, and also I can be found on my website, www.motivaholdings.com.
All right. So, Zihao, it was a pleasure talking to you today, and we'll surely stay in touch.
Thank you so much.
All right, take care.
Thanks for listening to Decoding Cash Flow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.